Hi guys, welcome back to my channel Ask Parul, and Ask stands for Always Seek Knowledge. And in this channel, I focus on sharing my knowledge and getting professional growth, helping people gain financial security and personal development to help and inspire people to live a well-rounded and successful life. So if any of these three topics resonate with you, then do subscribe to my channel. Look into the three playlist of my channel for other useful videos. I've linked the three playlists in my description link so that you can go and check that out. And thank you so much for everyone who has watched my videos so far. I think when I first started my YouTube channel, I didn't expect that I'll get such a good response. So thank you everyone who has seen my videos, who have subscribed to it, who have given me the comments and feedback as well. It really means a lot to me. And thank you so much for motivating me to keep continuing to make these videos. Because someone recently gave me this feedback that I should be thanking a lot in my videos. So I really want to thank everyone. Even if you have contributed a little bit to help grow my channel, I would really like to thank everyone. So, welcome back to the investment series. We are in the last episode of this investment series. I hope you have looked at the first three episodes. So in episode number one, we spoke about what is investing. We looked at different kind of instruments. In episode number two, we did a deep dive in terms of what are stocks and bonds. We compared them across four different parameters. Please go and check that out. In episode number three, we discussed about mutual funds. We took a deep dive on mutual funds. We looked at actively managed mutual funds. We looked at passively managed mutual funds, how their profits work, what are the pros and cons. So, we are in this final episode where we will be talking in detail about index funds and ETFs, which is exchange traded funds. So, just kind of continuing with episode number three, which we recently saw, that where I spoke in detail about the two kind of mutual funds, which is active managed mutual funds and passively managed mutual funds. So just to give you a bit of a recap in terms of what we discussed in the last video, so there are three key differences in terms of the actively managed and the passively managed mutual funds. The first key difference is in terms of the way, the management style, basically. So in the actively managed mutual funds, you have a fund manager who is trying to outperform the market index. In the passively managed mutual funds, it tries to not outperform, but it tries to keep up with the market index that it is being indexed upon. Let's say, for example, an S&P 500. The second difference is in terms of the investment objective. Like I said, the actively managed mutual fund, because it's being operated by a fund manager, like a professional manager, it tends to a fund manager or the management team basically make all investment decisions. They are free to shop for various investments across the fund, across multiple indexes within the various investment types, and they can choose which stocks that they want to purchase and how much they want to purchase. So it's basically most of the decisions are taken by the fund manager or the management team. However, in the passively managed mutual funds, because no one is actively managing the portfolio, the performance is simply based on price movements of the individual stocks in the index and not someone trading in and out of stocks. And that's why it's called passive investing strategy. And the third key difference we saw was in terms of the cost, because the actively managed mutual funds have these overhead expenses in terms of the management fee and other kind of fees. The fees, which we spoke in the last video, something called as an expense ratio, is a bit higher when compared to the passively managed mutual funds. So that was just a quick recap of the active mutual funds versus passive mutual funds. I wanted to give that background because I think then what I'm going to talk next will make a lot more sense. So in this episode, like I said, we are going to focus on two kinds of passive investing, passively managed mutual funds. So the two kind of passively managed mutual funds are index funds, and second is the ETFs, which is exchange traded funds. So we will look into in detail around what are the similarities between the index funds and the ETFs, and what are the differences, so that you can make so that you have few considerations in mind and can help you decide. And one thing I would like to also point out, as I keep saying in my previous videos, that uh, this is just a general information. Do your own research before taking any investment decisions. Seek for a professional help if you want to. Look for an active financial planner who can review your personal circumstances and can advise you. Most of my videos are for helping people gain financial literacy so that you are aware about things. And please do your own research and do take professional help before progressing to any kind of step. So that was just a small disclaimer. So coming back to index funds and ETFs. So let's first talk about index funds. Now, index funds are made up of stocks or bonds that are listed on a particular index, like any other passive managed mutual funds. So the risk aims to mirror the risk of that index, as do the returns. So the returns would also kind of mirror the returns of that index. So, for example, if you own an S&P 500 index fund, let's assume the index fund is on S&P 500, and if you hear that the S&P 500 was up 5% for the day, that means that your index fund should also be up about that much as well. And likewise, if it goes down, let's say by 5%, your index fund is also by down by 5%. Next, we have is the ETFs or exchange traded funds. Now, an ETF is a type of mutual fund. It's also a type of passively managed mutual fund, similar to index fund, and it offers similar benefits like of any other mutual fund. Like they are very diversified and they have less risk, and it bundles together many different stocks in a single fund. I have made a separate video previously comparing what are ETFs and what are stocks, ETFs versus stock. Go check that out. But typically, a stock is an investment in a single company, while ETFs bundles together funds from many different companies and put together in a single fund, and it's a lot more diversified, similar to index funds as well. Now, you must be wondering that it sounds very similar, right? So let's first take a look at what are the things that are common between ETFs and index funds. And then subsequently, we'll also look at what are the differences between ETFs and index funds. So let's first take a look at what the index funds and ETFs have in common. So ETFs and index funds both bundle together many different and many individual investments, such as stocks or bonds, into a single investment, and they have become a popular choice for investors for various reasons. So there are three things which both index funds and ETFs have in common. Number one is diversification. Now, both index funds and ETFs can help you to create a well diversified portfolio. For example, an ETF or an index fund can help you to gain exposure to hundreds of different kind of companies within a country and even overseas as well. So depending on the kind of companies and their funds, which are sorry the shares which are there in a single fund, you can kind of compare that whether it's more skewed towards a particular kind of companies, or it's maybe skewed towards a global phenomena, or maybe local to a particular geography, let's say US, China, or India. So it's a lot more diversified. So that's number one thing which they have in common. Number two, what the index funds and ETFs have in common is that they both are low cost funds. Now, index funds and ETFs, because they both are passively managed, which means that the investment within a fund are based on an index, such as the S&P 500. This is a bit different to, like we were discussing previously, to the actively managed mutual funds, because in an actively managed mutual fund you will have a professional manager who is actively looking for what to invest in, and generally these actively managed funds results in a higher cost in fees. But because ETFs and index funds both are passively managed mutual funds, they both tend to have a lower cost when compared to the actively managed mutual funds. And the third similarity that both these two funds, the index funds and ETFs, have in common is that they both have strong long term returns. Now, for long term investors, the passively managed indexed funds tend to outperform, like we were discussing, the passively managed mutual funds will tend to outperform the actively managed mutual funds. And the reason is because passively managed mutual funds follow the ups and downs of the index that they are tracking. And these indexes have historically shown much positive results in the long run. So you can't expect, great significant results in the short term. The larger you hold your portfolio, the better returns it would give in the long run. The actively managed mutual funds may perform better in the short term, And this is because the fund managers are usually making investment decisions based on the current market conditions and their own expertise. But given that there is less probability that these fund managers will make consistent and market beating decisions over a long period, and also just keep in mind that these actively managed funds also have a higher expense ratios because they are professionally managed. It can, both these factors combined can lead to lower returns over time when compared to passively managed mutual funds. So the ETFs and index funds both are passively managed mutual funds. They have these three things in common. Number one is that the diversification. The second is that low cost. Both your index funds and ETFs are low cost funds. The number three is that both the index funds and the ETFs tend to give stronger long-term returns. So, in terms of the differences between index funds and ETFs, now there are three or four key differences between index fund and ETFs. The first thing is that how they both are traded. Now, the biggest difference between index fund and ETFs is the way they are traded. ETFs can be traded throughout the day, just like an individual stock, so it allows the intraday transaction. But in the index funds, it's usually at the end of the day when the price of the stock is decided, which means that the index fund can only be bought and sold for the price which is set at the end of the trading day. Now, of course, if you are a long term investor, this shouldn't really matter as much because, if you are buying or selling, let's say at 12 o'clock in the noon or let's say at 3 p.m. in the afternoon, it's going to have very little impact on the value of investment. If, let's say, you're a long term investor for 10 or 20 years, it would hardly make a difference. But if you're a kind of an investor who is interested in intraday trading, like you want to kind of trade throughout the day, if you are that kind of a person, then maybe ETFs are much better suited to your needs because the index funds, you can, like I said, you can only buy and sell them at the end of the day, unlike the ETFs, which can be which allows you to have that intraday element as well, so that you can buy and sell throughout the day. So that's the biggest difference between the index funds and the ETFs. The second key difference is the minimum investment required. Now, in many cases, ETFs will generally have a lower minimum investment as compared to the index funds. And most of the time, all it takes to invest in an ETF is the amount needed to buy a single fund. And some brokerage firms will also offer you fractional shares, which means that you can buy smaller units within a single fund as well. And that probably translates into a lower minimum investment when compared to the index funds. So in a lot of index funds, you will see that brokers will often put a minimum amount that you need to invest so that you can buy those index funds. And it's generally slightly higher when compared to ETFs. The minimum investment required. So, if you're the kind of investor who just has a small amount to invest in, or you're just getting started, probably consider an ETF with a share price that you can afford, or an index fund that does not have a minimum investment amount. That can be a good starting point for you. So the third key difference is which is not a big difference, but it's still a difference, is that ETFs are a lot more tax efficient when compared to the index funds. So I think, like I said, because both the index funds and ETFs, they both are passively managed mutual funds. Of course, they have a lot in common, but these are these minor differences, which, of course, if you are a long term investor, it will not matter to you. But still, if you're just getting started, then because ETFs have a lower minimum investment required. It also allows you to do intraday trading. However, index funds, can only be bought and sold at the end of the end of the market. These are like minor differences. But both these instruments are really good for long-term investment if you are keen on. And like I said, despite their differences, both index funds and ETFs do have a lot in common, like diversification, lower cost to invest. And passively managed mutual funds can also offer stronger long-term returns when compared to the actively managed funds. But actively managed funds, of course, have an advantage that you don't have to be hands-on. You have a professional manager who have that expertise, who can track the results for you. But of course, it comes with the added expense ratio and slightly higher fees. So it totally depends on your personal circumstances and the way you want to manage your investment portfolio. Like I said, these videos are just for uh, education purpose and to kind of give you that financial literacy and awareness so that you can make the right decisions. So I think, yeah, that kind of brings us to the end. I would also like to discuss a few other things in a bit. All right, so I hope that it was helpful. I think there are just a few things that I would also like to discuss. So just people for people who are new and who don't understand what an index is. So an index is a collection or a group of securities such as stocks that are used to measure the health of the broader market. So for example, you may have heard of S&P 500. So S&P 500 is S&P Standard and Poor's 500, which is an index of performance of the 500 largest US public companies. Likewise, you may have heard of NASDAQ, which combine together as different technological related companies. You may have heard of Dow Jones Industrial Average, which is a well-known index, which tracks the 30 largest US firms. So typically these index, like I said, is a group of securities such as stocks, which is used to measure the health of the broader market. And I think another thing I would also like to mention is, this is a question that generally a lot of people ask is that how do index fund how do we measure the cost of index funds? So there are three or four different kind of costs that you should be looking at. The number one is the minimum investment. Like I was speaking previously as well, that usually these index funds will have a minimum requirement of investments, maybe $50 or $100 or $500, depending on what kind of brokerage firm you take these index funds with. But they usually will have a minimum investment requirement, and it could be as low as nothing to as high as maybe a few $1,000s or few $100. But that's usually the minimum investment requirement. The second kind of fees which can be associated with index funds is the account minimum. So depending on the brokerage firm or depending on from where you are associating yourself with, sometimes brokerage firm can also ask for a minimum account, let's say maybe a $10 or a $20 or a $100, that they would want to have that to keep your account being in a running state. So do check that if there is a minimum account requirement. The third thing, which is actually the most important which is the main cost actually of an index fund, is called an expense ratio. Now expense ratios are the fees that are subtracted from each fund shareholders return as a percentage of their overall investment. So it can be as low as 0.04 percentage or 0.06 percentage depending on your index funds, but usually that's the main cost which is associated with these index funds, and also with the ETFs as well, actually, because both of them are passively managed mutual funds. And the fourth kind of cost which would usually be associated with either an index fund or the ETFs is the tax implications. So generally, whenever you sell your funds, whatever income you have generated, it's called as a capital gains, and usually that capital gains is taxable. So whenever you're filing your return, you would have to show that as an added income. And I think, like I said, index funds and ETFs have a lot in common, but of course, they have few things different from each other as well. The main thing about these is that they are both passively managed mutual funds, and they both allows the same benefits of a mutual fund, which is in terms of diversification. And the actively managed funds as well, offer all the benefits of a mutual fund, like diversification. It's just that they have some overhead expenses because they are professionally managed, but that can also be an advantage for different kind of investors, because if you're not a very hands-on person yourself, you want help from a professional agency or a broker who can kind of take decisions on your behalf, then obviously actively managed mutual fund can also be a good way to get started. So see which one works best for your personal circumstances, and what's the minimum investment that you are comfortable with, what kind of risk you are comfortable taking, because of course mutual funds carry risk as well. So if you are just a new person, maybe start small, try to get a better understanding of the market first before you can kind of take more active decisions. And I think, like I have said in my video as well, these videos are just for information purpose. So just take these more from a literacy standpoint, just to kind of gain an awareness. But this is not a recommendation of any sorts. This is purely from information purposes, so that you can take right decisions. If you really want to kind of take an active decision, then maybe it's best that you take a professional help who would review your personal circumstances, see at which life stage you are in, will track your income and expenses, and give you a much more targeted advice. I'm not a certified financial planner, by the way, and but it's just something which I like doing. And hence I like to share my knowledge around stuff. But if you are serious about it, like I said, do take a professional help. And I think I would also like to conclude this video by just one last thing, is that because this has been a long series, we've had 4 episodes. So what I'm also going to do is I am going to combine all these um, 4 videos into 1 hour video as well, which will be like an end-to-end tutorial. And of course, depending on if you just want to have a one-stop shop and a one-stop video where you can see end-to-end about investments, right from episode number 1, where we spoke about the basics of investing, stocks and bonds. We spoke in episode number 2. In episode number 3, we looked at mutual funds. In episode number 4, which was this episode, we looked at the differences between an index fund and the ETFs. So that will be like a one-stop video where you can go and check that out end to end. But if you are obviously not interested in such a long video, or if there are specific topics that you're interested in, then these short videos will help you as well to gain a better understanding. And thank you so much again, everyone. I really enjoyed making these videos. I think I learned so much myself while kind of creating and curating a content that can be helpful for my audience. Thank you again for all your love and affection and all your comments and people who have subscribed to my channel. If you're new to my channel, then do subscribe to my channel. Look into the playlist of my channel for other useful videos. I regularly post weekly videos around personal finance, professional growth, and also personal development, so that you can live a well-rounded and successful life. I will keep continuing to make these videos. Do let me know in the feedback in the comment section if you have any feedback or any advice, if you feel something can be done better, what is working, what's not working. Do keep me posted, and I will come up with a next series, hopefully on a topic which is also very interesting. But until I see you the next time, keep seeking knowledge, take care, and goodbye.